and stuff like that.
Workshop.
We can. So everybody out there, we are recording now. We're going to go ahead and kick it off. So thank you for attending today. Lance is not here, so we'll come back to Lance if Lance joins us. We are going to be kicking it off with Jeremiah.
Thank you, Justin, and thank you, Synctivate, for hosting this excellent, awesome meeting. Hello, everybody out there on the digital side, and you guys, the Synctivate team here. Yeah. So I'm Jeremiah with CORELOT Homes. Here's my business cards, and today we'll talk about what it takes to get into a new home. Name of our company is CORELOT. And that's because I know I came up in the business. I came up from handyman, and I kind of progressed through doing varying degrees of complexity and more involved jobs. And then when we started building houses, we were really good at building stuff. And so we kind of realized the hardest part of this is finding the land. And that's why we're called CORELOT, because that's what we focus on, finding land with technical solutions to do it, geospatial solutions, and working with a lot of people in the land hunting game, like Nate Dobbins and his group. So we can find a lot of stuff, and just to lean in, like with Lance, working with an agent is a great resource to really help you do that, figure it out, see what's out there. So we'll just talk a little bit about the home building journey. We'll see what our next slide is. So it's a pretty simple way to look at it. When you're getting started, you want to establish your budget, see what you're working with, and we break it down pretty simply. So you've got your lot, you have your site work, and you have your house. We like to do all these things at once. It's kind of all at the same time because they play into each other. The lot, you're looking for land, and you say you've allocated $100,000 for land and $100,000 for your site work, $300 for your house. You're talking a $500,000 house. This and Todd can speak to is in terms of how much that costs, and but you're going to have to be flexible. So you could find an $80,000 lot with $120,000 of site work. You could find a $150,000 lot that's finished, water, sewer, $50,000 of site work. That would be rare, but possible. And you've got your plan in mind. So we hit them all at once. We start hunting for lots. We'll have a plan in mind. We can design a plan. We can use one of our plans, and our plans are practically priced. That's our bread and butter, is building these practically priced homes that have a nice balance of quality and value. It's kind of like a modest luxury. They're super cost effective because we are a small volume production builder, and it's cool because we have some of the added benefits of building these houses with built-in options. They're very, very cost effective, and we've refined the plans. Now that being said, I mean, you could build a custom home too. And when we get to custom homes, obviously a little more expensive, a little more involved, a little bit more challenges with a new plan. We haven't worked out all the bugs, but that's really kind of it with planning. Planning is like, hey, what can we afford? What do we want? And then, our approach is, well, what's your budget? And we're going to give you the most value that we can for your budget. And if you really want something, it's like, we'll break it down into a day one, day two situation. Say, build a house, design it with an addition for the in-laws, planning on having that in-law suite down the road. Planning, we're going to find a lot with the house plan in mind. Sometimes we always adapt the house plan to the lot, to fit the lot. We put it on the lot. That's kind of my thing. They call me the dirt nerd. So the agents, all the agents we work with, like Lance, you're working with Lance, and he'll bring me the lot, say, look at this lot, let's take a look at it. And we pull everything we can on it and see what we have, expect costs. Permitting is pretty straightforward. We've got a building plan ready to roll, site plan. We do some soil studies, send that into the county, and then we break ground. With CORELOT, we want to keep it really simple. We're turnkey. So you don't really have to worry about anything except a few meetings. We'll have some design meetings depending on what we're doing, selections meeting, get it all together in a nice package. Right before we break ground, we come out, check out everything, and say, look, it's all good to go. This is what we're doing. This is where the house is going. From there, we'll build it, frame it, come in, look at everything before drywall. All the trades are in. We call this framing orientation, and then there's a final meeting and final quality walk. Take a look, walk around, little blue tape. We give you this much blue tape, and that's it. So from there, what was our next slide? Financing, I'll leave that for Todd. Permits, there is some, there's some minutia to that. That's where experience comes into play. Relationships with the municipalities are really valuable. Sometimes, it's tough to find a lot, and that's really the hardest thing, is to get within your budget. You're looking at, like, man, sometimes you find like, hey, here's a $400,000 lot. We've got a $150,000 lot budget. And the cool thing is that we can take that, and we're working with a lot of folks that are hunting for land. And we also develop land, so we could chop it up. We might build a couple houses right next door to you, right next to your house. We can go tackle a piece of property together. That's pretty cool. Helps with the budget. What else do we have here on this presentation? Oh, sorry. Okay, so architectural design and planning, right? We could do anything. We could do a small house, and I avoid the tiny home thing. I would say if you're thinking tiny home, maybe get a camper, but we do like small homes. That's pretty popular. Energy efficiency is great. Obviously, you can save a lot of money in the long run. Have all those options available. Sustainability. Building into really whatever you want, the small home, the medium home, the practical home. That's our bread and butter right there, is that practical home. And we design custom homes as well. So obviously working with one of our homes is very straightforward, very obvious. Like, here's the plan, here's a lot of structural options. It's a well-defined program. With a custom home, man, we'll engage from a big architectural firm and do incredible plans, and that's fun. That's a really cool engagement, working with an architect. We have designbasics.com. You can select from 1,000 plans, and we'll study that, modify it, really do whatever you want there. So with an architectural design and planning, it could be as simple as, there's the plan, option ABC 1, 2, 3, or it could be a full custom. Just about anything, really. Then we'll get into the site selection. Yeah, so this is where CORELOT really shines. We have a large focus on finding land, and there's a term I like to call, it's a French term in generalship. It's called coup d'oeil. This is the ability to discern topography at a glance. So, like ancient generals, they were all they had the gift of coup d'oeil. They could go and then walk the land and see the tactical advantages and disadvantages of placement on the land. So that's really close to what we do, is focus on the land and the dirt, and kind of like have some Frank Lloyd Wright inspiration in terms of building with the land and transitioning into natural areas from the building to the land. These sorts of things. It's really cool. It's really fun. We love to plan that out. That's one of my favorite parts. What else do we have here on these slides? Oh yeah. Okay. So we've got a plan. We've got some dirt, and then what does construction look like? Pretty straightforward. You put the foundation in the ground. We're going to prepare the site. We put a foundation in, then we, frame the house. And that's where we're going in and meeting again. We close it in, put a roof and siding on it, or whatever materials you want, really. We have some streamlined products that are really active in the market, very competitive. they move in a lot of volume. So that's where we're trying to really capture the value there. And then, you finish out a house with the interiors and then you final it out. Pretty straightforward. Quality control. So our quality control program is pretty robust. We focused on that early. We have a really well-defined program. You'll be hard pressed to catch something that we haven't already caught. That final walkthrough.
Excellent.
Yeah, excellent. When we're done, we have a house. Call and hook up your utilities. Water, sewer, gas, electric, whatever it is. I'm sure you guys have all done that. And you move in and meet your neighbors. Pretty. That's it. I think that's the end of it. Yeah. So should I take questions now, or you want to?
I would say I was thinking about doing them at the end, but we can do questions at the end as well. I don't want somebody to forget a question they may have. If so, I'm actually going to unmute attendees just in case the attendees want to ask any questions. But I do have a question right off the bat. So I know a lot of my team here has not. You guys have a lot of them haven't bought a house before, and I think maybe the thought of building a house might be a little scary for a first-time home buyer. Can you speak to that a little bit? Like, that's still a viable option for like a first-time home buyer and stuff.
Yeah, we have a lot of people coming to us, and some of the things that we're able to do in terms of building some of our homes, like delivering a finished home for $500,000, it's tough to find, and especially when you have specifics about where you want to be. So it adds a whole nother degree of flexibility to get where you want to be. And our goal at CORELOT is to make it simple, and we'll shepherd you through the entire process. So you can count on us to take you through all the way, and you don't have to worry about anything because we'll be there for you. That's there's obviously benefits to buying a new house. It comes with a warranty, and you have all new stuff, and that's really nice on the maintenance cost.
Insurance is way cheaper, surely.
Insurance is way cheaper. Yes, that's it.
Well, and Lance would talk about supply and demand right now, right? Especially the market right now. It's not a lot of houses out there on the market, so a lot of people are turning to building. So it's definitely a great option.
Yeah, I think you'll find that builders, along with our lending counterparts, we can be a lot more creative and get a lot more things done than you'll find in the used house market.
And so you guys have context. I've owned 2 houses in my life. I bought a house that was built, and then I built a house. Downsides with process, you learn a lot of things, but I will say, like in the building, my wife and I was the first time we built. We're gonna probably build another one eventually, and we've learned so much from this development. Going into that. The builder we went with only had like a certain number of plans. I know Jeremiah doesn't, do custom all the time, but working with a smaller builder like this, a more local builder, like you can get more of what you want than going with a bigger custom or a bigger company that like you can choose 3 different countertops or whatever.
Yeah, and that's a differentiation factor with CORELOT. We're really proactive, design intensive. So we, let's say you want to do a custom home, and if it's serving the broader market, well, with all of our homes, we do an intense degree of study and design development that you won't find from most custom builders that are just going to build it and kind of shoot from the cuff and work out the problems in the field. Unless it's a super uber duper custom and it's fully supported by an architectural and engineering team, we go in and we invest a lot into the plan as well because we want to adopt the plan. So we're not, it could take $20,000 or $30,000 to develop a real well-defined plan that meets our standards so that we can perform to the extent, because performance of construction is really important to us. The speed at which we can build it, it takes thorough planning. But we don't put the burden of that planning on our customers because, well, we're gonna take ownership of the plan and we're gonna add it to our lineup in certain cases when we lock in on something that serves the broader market. So we'll partner with you on that design, and we'll make it super effective for construction.
And I'm going to throw out one more last tidbit about you. I'm recently having a new office mocked up for Synctivate. Don't know if we're gonna do it or not, but the cool part about Jeremiah is like the materials used in the office. I'm sure you can do this on my home building as well. Like he's looking at local contractors to develop some of these materials that you can get it done cheaper than getting it from like a national company that does these materials and stuff. So can you do that on homes as well?
Yeah. So these relationships, these guys, these subs and supply chain that we work with, these guys have been working with since I was 12. So a lot of them know me, and what we're doing is we're aligning with the broader market to find a sweet spot of product availability, cost, and quality to really hit it right where everybody wants to be. That's another thing about our plans too. A lot of builders, they do this switch and bait. So if you go out there and you see, oh, I can really get this really cheap house, and you come in and they're like, oh, so you want flooring? That's another $20,000. It's like, oh, you want cabinets in your kitchen? That's another $30,000. So we don't play this switch and bait game. We load our houses with what we call the CORELOT standard. Comes with hardwood, granite tops, upgraded cabinets, nice stuff that generally what you see that everybody wants. That's what you're getting right out of the gate. And of course, while we can upgrade until the cows come home, generally our offering is right in line with what people want. And in terms of getting products, and we move some volume, so we're able to be pretty competitive.
I've got a kind of off the wall question. I read about this university that had developed this house design. It had no footing. It just used piers and cantilevers, and it was all code. It met code. It wasn't a tiny home. It was like 1,200, 1,400 square feet. Small, but you could build it for like $30,000. But they found out that the big problem is local code inspectors didn't understand. So like that was the problem. That's like a little too out there, right? Or does the price of land dictate the minimum square footage that you'd be willing to ever build?
Well, yes and no. So I'll address that a couple ways, because I love interesting projects. We'll go the distance, right? And like somebody called 30 guys about wanting to build a bridge, and he gets me on the phone and he's like, "You want to build a bridge?" And I'm like, "Yeah, let's do it." Like, so call some bridge engineers. It's pretty basic, and piers, pier foundations common, especially down in like Louisiana, Florida. It's really prominent in certain parts of the country. So I can see that being feasible. And in terms of building a 1,200 square foot house for $30,000, I mean, that's really interesting. I would love to see that. Now, to answer the second part of that question, when you get into small homes, then you do start to see the weight of the home value compared to the lot change pretty drastically in terms of what's generally expected. And the rule of thumb for a lot of kind of old school folks in the business is the lot is 30% of the total deal. I don't prescribe to that rule. If you can get a lot that works for you and that's the house you want, that's great. If it's new and cutting edge and the community doesn't understand it, in terms of the inspectors or the building department, a lot of times the way to just bring that through is to work with an engineer. And a lot of the municipalities will allow you to just about do whatever you want as long as that engineer is signing off on it. So I would love to take something new and fascinating like that forward. And yeah, we're pretty well equipped to do that.
Cool. And we have connections with engineers as well. Bree from Legacy is on the call right now. So, yeah, okay, cool. Anybody else got any other questions for Jeremiah right now?
Thanks, guys.
Cool. Thanks, Jeremiah.
Thank you.
We'll come back around at the end and do a Q&A too, because I'm sure there's probably going to be some other things that pop up across the board. Okay, so next we got Todd Call, Senior Loan Officer with Atlantic Coast Mortgage.
Senior. Oh, I'm senior, all right. My progressive on and lose my hair. Hey, everybody. Thanks for letting me come in and talk to you all. Thanks. I appreciate it, Justin. Good job on that. That was great. And, so the ultimate guide to the mortgage process. I know you kind of sync this together a little bit. So, and there's a lot of slides on mine, so we'll kind of go through them kind of quickly, and then we can stop if you have questions to answer them, and we'll go to the end. But just a little background on me. I've been doing this for about 22 years. I'm second generation in the mortgage business. My father was in it. So, and a lot of my family is in real estate as well, in Northern Virginia and Richmond. My grandmother was the first lady to be in charge of the real estate board in Richmond. Yeah. So my grandfather and her started a company after World War II. And when everybody came back for the war, they were buying houses. So my grandfather would go drive his car out, take the contract out, and everybody signing on the hood of the car. That's how it worked in those days in the 50s and 60s.
It was like $1,500 back then.
Yeah.
That's
Yeah. So, but that's kind of how it worked. And that's kind of, I like to tell that story because you can overcomplicate this process. It's really simple. You just got to look at the numbers. And then if you're comfortable with those numbers, then you can push forward on a lot of these things. And you just need to have somebody explain all those questions to you and things like that. So we can kind of jump into it. Cool. Yeah. Let's see. Yeah. So just kind of going to go over the basics of home buying process. I'll jump into kind of the realtor mode too a little bit to lead in. Because in the builder, they kind of do the same thing. So I'm kind of like the first step because I'm the money guy. So you have to have that moolah, to buy a house. You can go and look, but then you're like, okay, I want my payment to be $2,500 a month. Well, what does that relate to as far as the house price? The realtor's going to go, we need to call Todd to get pre-approved to see if you can afford that. The builder's going to kind of do the same thing. So we're going to kind of go through that real quick. So we can pop it over to that one. We'll go over, the loan process, loan types that are out there for first-time home buyers, 100% financing. That is available. Let's see why pre-approval is a great first step. The application, what are interest rates? What's an appraisal? Kind of the do's and don'ts of the mortgage. Don't go buy a new car when you're in this process. Try not to switch jobs, things like that. I see you shaking your head over there.
Yeah.
Yeah. So, but yeah. So you pop on to the next one. Okay.
Great.
Yep. So these are some of the people that are involved. I'm the loan officer. I'm the front end that you would call me, and then I would take your application. The loan processor is kind of my right hand that kind of gathers all the documents through the process, like your W-2s, your pay stubs, your tax returns, those sorts of things, depending on what job type you have. Then the underwriter, that's the person we want to be nice to. They're the decision maker on the loan. They're the one that goes in and goes, okay, does this loan make sense? Does this person qualify? Are they going to repay this loan? Because that's really what they're looking at. And then the closer, that's the person that sends all the documents to the attorney or the title company at the end when you sign on the dotted line when you buy your house and get your keys at closing day. Real estate agent, that's the person that kind of shows you the market, shows you what's out there. They have access to the MLS. Everybody kind of knows what the MLS is. Mm-hmm. It's kind of, Zillow, that's same thing online, but the MLS is the old way of doing things, but they've updated it. They're going to kind of give you a drip campaign and show you the price range of houses that you're looking at. So that you'll get constant emails from Lance every day. Hey, this house hit the market. A lot of times on Thursdays, those houses are going to hit the market because they're going to ramp it up for competition on the weekends and make a decision on Sunday or Monday. And so you'll see that a lot of houses hit the market on Thursday. Home inspector. That's different than a home appraiser. So a home inspector is really going to dig into the nuts and bolts of the house. They're going to look at the HVAC system. They're going to look at the foundation. They're going to look in the crawl space. They're going to look at the attic. They're going to go through and test all the GFI networks and all those sorts of things. Yeah, no worries. They're going to really give you an in-depth report on that house to make sure it's a viable option for you. The home appraiser, that's more of a value. Looking at the value of the house, making sure the house is worth what you're paying for. Okay. And that way we can do the loan as well. The settlement agent, that's a title company or attorney. They're going to go to the courthouse and make sure there are no liens against that property and do the research on the title of the house. Because you don't want to buy a house that has liens against it because it can cloud that title and then you couldn't sell it down the road. You could have issues unloading that house if you wanted to resell. And then you would sign all your paperwork with the title company, settlement agent there at the end. They facilitate all that. So pre-approval documentation, find a home. So when you come to me, we, first initial meeting is usually over the phone. We do Zoom, meet in person. The first couple of questions I'm going to ask you are, okay, what do you want your payment to be? How much money are you going to want to inject into this property? And do you and you're going to ask if you qualify. I kind of do it like that. So what we're going to do is do an application, look at all your income, pull a credit report, and I can go over touching on credit reports later on kind of how they, come up with those scores. And then we run all the numbers and come up with your debt to income ratios. Have people heard that before? Yep, debt to income ratio. So I'll touch on that later. Then we collect all your documentation. And a lot of times this day and age, we can do electronic verifications on your employment. There's something called the work number out there. And they line up with all the HR departments in a lot of the bigger companies. So I can hit a button and it tells me all the income over the last 2 years. So I don't even need pay stubs sometimes, which makes it nice.
From the HR department here. So.
Yeah. Some companies have it. So, but some of the stuff you would give me, I'd ask for, pay stubs. If you're self-employed, we get a little more in depth because we have to look at your tax returns for the last 2 years, kind of average the income. Things like that, because when you're self-employed, you kind of want to write some stuff off so you don't have to pay the man, the IRS. So we go through that, and there's some depreciation, different things we can add back in for income that helps with that. So when you're self-employed, it's a little more documentation. And then you would go and you would find a home once you know what you qualify for. Hit the next slide. Then you would be working with the realtor to present that offer to the seller. This market, it's, there's not a lot of inventory, so people are competing a lot. And that's why sometimes building is a better option because, you can go, you find that lot, you're not competing with other people, you get what you want. So you're competing and, I would give you the pre-approval letter to give the agent so they can present that offer to the seller. And then if your offer gets accepted, then the next step would be going and doing a home inspection, if that is something that you wanted to do on the property. I think it's a good idea because you kind of know what you're getting into. You don't want to go to a house and everything's broken and you have to come out of pocket $30,000 or $40,000 unless that's kind of what you're going after, a fixer-upper. And then we would do the appraisal to make sure the house is worth what you're paying for it.
Sorry, I jumped in.
Yeah, no, that's perfect. And then we would get all your documentation. The underwriter would underwrite the loan and they would approve it. And they always come back with conditions. I haven't had maybe 1 or 2 loans after 22 years where they haven't come back with any conditions. They have to justify their jobs. They're bean counters. That's what I call them. So, all right, well, I need an extra pay stub, or hey, what's this large deposit on the bank statement? Why is this in here? So we got it sometimes on loans. When you dump a bunch of cash in your bank account, we don't have a paper trail on. Let's say you sold a car, you sold a motorcycle, sold a bike. They're going to want to know what it is on some loan types. So as long as we can kind of, justify that, what they're worried about is we get audited by the Fed and they're worried about money laundering, drug dealing, terrorist activity, something called the Patriot Act that happened in 2001 after 9/11. So we have to go through and kind of do that. So if you've got cash, you want to, don't put it in your bank account or talk to the loan officer before the process. That way he can kind of guide you on what to do with that cash. You might need it for the house. There's other ways to kind of get it in your bank account or explain it properly to the underwriters. And then we satisfy all those conditions. Then you get a clear to close. That's a good thing. Ready to buy the house. So you're clear to close, and then you're set to go to close and get the title company and sign all your final paperwork. Yeah. All right. Next, we'll go into loan types. Does everybody know what an ARM is? Adjustable rate mortgage. They're not very viable right now because an inverted yield curve is kind of the environment we're in. I don't want to get into all that. I don't really like advising on ARMs unless for 99% sure you're going to be in and out of that house in a certain amount of time, because the interest rate is only locked for a short period of time, and then it can adjust. So your payment could rise. It could go down, but it could rise. So I always like to counsel folks, especially first-time home buyers, on a fixed rate mortgage where it's locked in for 30 years, 15 years, 20 years.
I mean, was ARM a big part of the 2008 stuff?
It was.
Yeah.
Yeah, it was. On some of those option arms where there was deferred interest on those loans. Yeah, it was a problem.
So like people would have like could have an interest rate, I'm just,
No,
like 3 or 4%, then 5 years into their house, it's at now 8%, 12 or whatever.
Yeah.
So that payment just went up $500, $600, $700, $800 a month. And it's
Yeah.
like, we can't afford this.
You could just state your income too, I think.
Yeah, we call them drug dealer loans. Yeah, no docs. So we just, all right, what do you make? And then they were insuring that paper, selling that paper all the time. And that's what caused the crash back then. It was a mess. We're not in that right now because they cut a lot of those loans out and they put a lot of regulations on us. So we have to be very transparent on our stuff. We can pop to the next one. Construction loans, especially for building a house. So the builder, sometimes if you're not a huge builder where you have access to a lot of capital, they will, on a custom home, they'll want a construction loan. And so basically we do the loan off your balance sheet, which means we're going to lend and keep everybody honest when you're building the house and go through that process. So we do it in draws. So we'll give the builder chunks of money as that build that house all the way to the end. And then you roll your mortgage into a 30-year fixed mortgage once it's done. Okay. So we're kind of funding it, for 12 months, 18 months, however long it takes to build a house. FHA loan. So FHA has a little more loose guidelines as far as credit. So a little bit lower credit scores, down in the lower 600s, things like that. They require that you put 3.5% down on their loans. So, and I'll touch on that a little bit more with first-time home buyer stuff. Next one. USDA loans. I kind of like those loans along with VA loans. So USDA is specific for a area, but you'd be surprised. All of Caroline County is eligible for 3/4 of Spotsy is. The good thing about a USDA loan, it's 100% financing. And the mortgage insurance, which you have to have if you don't put 20% down on a loan, is very inexpensive. It's probably the second best loan unless you're a veteran, like I am, prior military, specialize in VA loans. So VA loans, 100% financing, and there's no mortgage insurance. And if you have a disability, you don't have to pay the funding fee on it, which makes your payment a lot less. Jumbo loan programs, those are for more your high-end houses that don't fit into a certain price point. So, your $1 million, $2 million houses on the lake, or you're in DC or Northern Virginia. Those are specialty loan programs because we can't sell those off on the secondary mortgage market with Fannie and Freddie. The next one. Okay. Yeah. Why get a pre-approval first? To know what you can afford. Get ahead of it. So, use this example. You're like, okay, you meet with a realtor and they're like, you need to call a local lender, make sure you get pre-approved, and you kind of push it off. Then they take you out and you start looking houses on a weekend, and come to find out there's 5 offers on that house. You're like, oh crap, we're scrambling. We got to get pre-approved. So I'll get a call on a Saturday afternoon, which happens all the time. I work all the time. I work nights, weekends. It's just the way it is. And we got to scramble to try to get that offer in. If you do it during the week, then we have extra time to kind of vet the file, get everything lined up, kind of give you more options and talk over things. That way you're not rushing into this. When you're buying a home, this is the most expensive thing you'll probably buy in your lifetime. So the way I look at it is you want to spend a little more time thinking about it, going through, looking at the numbers, looking at a couple of different loan programs to see what makes sense to you. Also, if you kind of know you're in negotiating power too, you're not scrambling, like, because you're going to get into a bidding war and then you go, oh, I don't want to go that high, I don't want to go that low. Ahead of time, you can kind of run those numbers and go, okay, if I go up another 10,000, what's that going to do to my mortgage payment? So it gives us a little more time when you get pre-approved first. And then it reduces unwanted surprises. So if you don't have all your docs and then you're like, okay, I'm kind of think you're okay, you don't want to be kind of pregnant, you know, that's not good. You kind of got to know what you're doing. So you don't want to have surprises. So move on to the next thing. Here's some of the basic stuff you need. We'll need your ID, social security number, that's, you know, bank information, W-2s, pay stubs, and all of this. I have an online app I can text to people, and I just text it to them, and it has AI built in it, and it'll coach you as you go through what to upload into that system. So it's pretty robust, and it works pretty well. So those are some of the documents, kind of examples that we use.
I just want to throw up for my team, your IRA and stuff helps you with stuff like this too. So we did sort of IRA last year, so make sure you're contributing. So if you want to buy a house, having that to be able to show that to them,
It's an asset
is a benefit.
for reserves. Sometimes we need it, things like that. Okay. Credit scores, you know, kind of what goes into that. You can kind of see, like, big chunk of that is your payment history, right? So paying on your credit cards, on your monthly obligations, car loans, student loans, things like that, and how much you owe. So credit card utilization. You know, I kind of cut my teeth in this business with credit repair with folks. So I can kind of go in on the credit reports and run an analyzer and go, okay, let's say your score is about a 619 middle credit score. We really need to get this up over 620, maybe to 640 to get a better rate or get our approval through our system. I can tell you what you need to do. Let's say you've got a credit card that's got a $2,000 limit on it and you've spent $1,000 on it. Let's get it down to 500 and your score will jump up 15 points within 10 days. We do a lot of that. Or, hey, there's a collection on here. Should I pay this collection off? No. So don't pay that collection off. That's actually going to hurt you because you're admitting to guilt. We're not going to require it on the loan. Don't pay that off. Let's take that money and pay some other credit card debt off. It's going to get that score up. So we go in and do a lot of that with people and help them build their credit and get it where it needs to be. That's like half of my job on a daily basis. What are some of the other things? Your credit accounts and then length of your credit history. Those are all the 5 factors that kind of go into your credit score. Yeah. Kind of so you can see the ratios on that, your payment history and how much you owe. That's a big part of it. Okay. Pop on the next one. Yeah, this is kind of going over the app and kind of what information you put in there. You know, your employment information. You know, a lot of folks are like, I had a young lady email me last night. She's like, my mom doesn't think I can get approved because I graduated college last year and I've only been on my job 1 year. And she said, I need 2-year history. That's not true. So there's a lot of misconceptions out there with it. That's why you want to call a local mortgage person. They can kind of walk you through that. We can use your college transcripts, you know, as job history on some instances. Yeah, income, you know, just kind of tells you what information goes into the app, into the application. You kind of pop to the next one. Okay. So, what's included in your monthly payment? So there's a principal and interest payment. That's your actual mortgage payment. Then you've got your escrows, which is homeowners insurance. You've got to have that on your house for protection. And then your county taxes or city taxes. So that encompasses your mortgage payment. And if you don't put 20% down, monthly mortgage insurance. Does anybody know what mortgage insurance is? No. So they've done statistics and studies over the last 50 years. And the less skin in the game you have, the more likely you're going to foreclose on a house. That's not saying you're going to do it, but mortgage insurance is on the loans. When we have to foreclose on a house and take it back for non-payment, it gets really, really, really expensive. So mortgage insurance helps us recoup some of that cost and protects us. That's what mortgage insurance is.
I can, for you guys, so you guys know, when Amy and I built our last house, we only put 15% down. And we had to pay a couple $100 a month towards mortgage insurance. Cool part is once you get 78%, I think it's
78%, it drops
that comes
off.
off. So we've gotten that. So now our mortgage payment lowered by $200 a month because we don't have to pay that anymore.
Also, some loans like conventional, we can wrap that into the payment, so you can write it off on your taxes as interest. When you do it as a monthly, you can't write that off. So there's smarter ways of doing that, and that's why you want to consult with a mortgage person to figure that out. At the next
That
one.
risk isn't in the interest rate. Is that because the mortgage gets sold off? So you're kind of isolating the risk to one
Yep.
part of the process?
Mhm. Yep. So whenever principal and interest, there's the mortgage insurance there. Kind of touched on this. The next one. Because there's a ton of slides in here. Okay, what decides the interest rate? You know, a lot of different things. Credit score. So a lot of people call me and go, okay, Todd, what's your interest rate? What's your interest rate? Well, sir, there's a lot of things that go into that. Are you a veteran? Are you a first-time home buyer? How much money are you putting down? What's your credit score? What's your DTI? Those things go into it. So right now, I don't want to say it, but interest rates are over 7% on a conventional loan. You know, that's kind of the bucket we're in. But, you know, if the payment works, then, you know, that's kind of what you got to focus on. A lot of people focus on the interest rate. You got to focus on that monthly payment because that's what you're living with every day. You know, that's what you're paying at the end of the month. You know, and you can always refi, and we can get into that later on what a refinance is. All right. We're in an inflationary environment right now. That's why interest rates are high because of the cost of goods. You go to the grocery store, you pay gas on car, everything has got expensive. So interest rates have to go up to kind of tame that or try to tame that. I will leave that subject alone because we could sit here and talk all day about that. But there's a lot of things that go into interest rates, and those are some of them. And that kind of shows you some of those trends right there, as you see. You know,
Sorry.
no, you're fine. But yeah, and then I think these are some of the terms. We kind of went over what an appraisal is. It's more for the value of the house. And I'm kind of spitting this off a lot as we go through this. And that's what, yeah, no, you're good. You're good. You can kind of go through on that.
Okay.
Do's and don'ts. You know, pay your bills on time, you know, be mindful of your credit, always kind of check it. I mean, there's a lot of stuff going on out there with identity theft. You kind of got to be aware of that. Everybody knows they've got that call from their bank saying somebody's used their debit card somewhere. God, don't do this, you know, when you're in the process, don't change jobs. You know, don't close credit card accounts. Kind of keep them open because that's going to suck that available credit away and actually hurt your credit score. A lot of people don't know that. Okay, go on to the next one. Sorry.
Well, you guys aren't allowed to change jobs ever again. So.
Yeah. Yeah, so 3 days before settlement, you know, this is some of the transparency stuff that we have to do. We've got to send out something called a closing disclosure. And those are the final numbers that you're going to look at the table. And you have to sign that before you go to closing. Back in the day, they could change stuff up to 5 minutes before closing, throw extra fees on there. Everybody's mad. It was not good. So now I like it because you get that 3 days ahead of time. If there's any issues, we can work through it, get it fixed. Then you know everything's on the up and up. Everything's good to go. You know, those are kind of some of the things. You know, how much money you need to bring to the table. You can wire that money a lot of times to the title company and talk to them about those things. The next one. You know, kind of go over all the documents. You want to ask questions, don't rush. You know, a lot of people just kind of go through and sign that stuff. That's the questions. You know, you're paying a title company or attorney that's involved in that transaction to represent you. So you want to look at and ask those questions on all the mortgage docs. And then you can also call me or I'll be at your closing and kind of guide you through that. Yeah, so that's it. And we can get more into products with a Q&A later. That way I can kind of get into the 100% and other things as well.
Cool.
That way.
Yeah.
Yeah.
We'll do a Q&A.
Yeah.
Cool.
All right.
So next we got Corbin.
Corbin, I'm an insurance guy. You bought your house or you built your house, then you pay for your house. Now you need to protect it. So I'm very passionate about insurance. I was a lawyer before I did this. I litigated these policies. And I just saw a big void where people they had no idea what even home insurance does, how it's useful. you look at some of these policies that we've seen and there's nothing there. You're just buying an expensive piece of paper. So our goal is to help correct that. So if you want to jump right in the slide. So what I want to do is just help you understand what it is. It's just to give you kind of a brief overview of what the coverages are, what everything means, like how you find out what your premium is going to be. And that way you can, when you're walking through these homes and you're picking home, because all this goes into your debt to income, at the end of the day is what your insurance cost rolls into that escrow account, which is going to be part of your mortgage. So if you want to roll on, all right, so what affects your premiums? How do the carriers come up with these numbers? That's what we'll kind of dive in. So big thing is location. This is one of the biggest drivers is location. Obviously, the closer you are to waterway, coastal, anything like that, it's going to be a higher premium because the likelihood that you're going to have a claim is increased. You know, there's more storms that come through the coast. There's more wind claims that come to the coast. So all that's going to factor in. Protection class, all it means really is how close you are to fire suppression. So it's ranked from a scale of 10 to 1, 10 being the worst, 1 being the absolute best, meaning I probably got a fire department right around the corner. In order to be a protected class, you have to be within 7 miles of a fire department. So just something, it's not something you're going to use to make your decision, but it's something to factor in when you're thinking about where you're moving. Zip codes are very important. I could be literally a house right next door to you, but if this zip code has a larger storm history for whatever reason, larger hail history or anything, even though it's not really that house because it's right next door, you're going to pay a higher premium on one side of the street than the other, just depending on zip code, because that's all they have to rate it is that zip code. About long over. All right, so the home itself, obviously, this is also one of the biggest drivers, the construction material. What's the rebuild cost of that home? And just to let you know, so how that's factored, I'll just kind of pull back the envelope a little bit. When I get it, let's say Todd sends me one of his clients and we have to run their insurance. So what I do is I'll go in their system, plug in your address. A lot of the information is pre-populated because the listing's online, so it pulls that information automatically. But we go in and fine tune it into what they call a replacement cost estimator. That's where they put in the type of materials that are used, the size of the home, bed, bath combinations, garages, decks, anything like that. And that's what spits out what the dwelling replacement cost is, which we'll go through those coverages and what they mean more. But a big thing, and I'm just going to point this out, is age and condition of roof, because with this crappy market we're in right now, carriers are all about roofs right now. Some carriers, we've had a lot of carriers who pull out. If your roof is 10 years or older, they're not writing you. They're backing out. Progressive literally came out yesterday and said, if you've got a roof that's 10 years or older, we'll pull it out, which is insane because roofs last up to 30 years. So it's putting people in a tough spot because Progressive is one of our value carriers where you're going to get more bang for your buck. But we have a lot of specialty companies. So we're independent brokers. And that's also something very important. Use a broker when you shop your insurance. Because I shop about 50 companies. I don't work for the insurance companies. I work for the client. My job is to find you the best policy and then to advocate for you if you have an issue or a claim. So if you work with, let's say, a State Farm or somebody that works directly with that carrier, that's just paying their bills. Like that's paying their salary. That's their employee. I don't work for any of these companies. I go toe to toe with these companies all the time for my clients. And I'm talking from service aspects. If they don't answer the phone in enough time or they don't answer your emails, we're on it. Like we're your advocate to help push things through for you. But like I said, roof is a big thing. HVAC systems a little bit, not really. Trampolines, just don't put one in because your insurance is going to go crazy. It's the largest driver for kid injuries ever, and it's always severe. And the worst situation is if you buy a home, you put a trampoline and don't tell your agent, there's no coverage there. So let's say you have, your kids' friends come over and they fall and get hurt. You don't tell us, there's no coverage. Like
I got one sitting in my backyard right now and nobody knows.
And
My kid flew face first off it the other day.
My kids want one. I was like, nope, not getting it.
I do not do it unless you just tell your carrier because a lot of carriers won't write them. So you could have a carrier that would disclaim all coverages if they come see that trampoline.
Huh.
Or we had one claim, wasn't mine particularly, but we had a claim that a kid had fallen off and died. Oh, and there's no coverage because the trampoline's never disclosed. So your insurance agent, at least for us, and this is just me personally, I'm not every insurance agent, but I'm very personal with my clients. Like I want to build that relationship with you. So if you do get something, just text me and say, hey, Corbin, I did this. Do you think I need to tell you? Yeah, I mean, let's talk about it so we can help make sure that you're properly insured. Because let's say you add a pool in your backyard. Well, if you have a pool, that's $100,000 product you just put in your backyard that's not insured properly unless you tell me. Because I need to increase your other structures coverage to protect the pool. So it's really the biggest thing is just open line of communication with your agent. Just talk to us. Let me know what you need so I can help you. These other couple of things are, they go into it. Claims history is also a big thing of the home. You're going to see it again because it's also for the person, but they will pull. So let's say I buy a home, and it's got a huge claims history, the home itself, not you, but the house. That's going to affect your rates. But the benefit is I'll pull a claims history so I can tell you what this home's been through. So you can see, hey, this home has had a history of water claims over and over again. Maybe this isn't the house for me. So it's just things that we can do to help advocate for you in a different way. So we can bop on
Well,
over.
land skirt, why would acreage, if you're not really insuring the land?
So, but it's an open nuisance or attraction. So if I've got this open piece of property and it's not fenced in and it's just like this vacant land, people can come onto your property without you knowing. And then they could get hurt in the property and then they're going to sue you. Because there's different degrees of duty owed to a person. So a trespasser you owe no duties to. And this is kind of more legal talk than insurance talk, but a trespasser you owe no duties to. But let's say you don't put up no trespassing signs, somebody wanders on your property. You owe them a duty of care on your property to them. And you don't even know that. You don't even know these people. But then if you have an invitee, which is somebody you invite, then you have the highest duty of care, which means you have to warn them of anything. You have to take care of your property. Whereas if it's somebody that wanders on property, but you don't have no trespassing signs up, you owe a duty of care that's just enough to where you have to make sure the land is maintained properly, but you don't have to give them a warning. Whereas if, let's say you invite somebody over, then you're like, hey, I have this hole in my backyard or something. You need to actively make somebody aware. So that's why it's important. And certain carriers won't write over certain acreage, like Progressive, just to keep ragging on them. 5 acres is their cap. Like they will not go over 5 acres. That's their limit. You own more than that, they're not touching.
On the pools and the trampolines, is that like a flat multiple there, or does it factor in like if the pool's got a fence around it, if the trampoline's up and has a net, or it's
You'll
in the
need,
ground?
if you have a trampoline without a fence and without a netting, you're nobody's right. They're just not touching.
Well, at least I got that.
Yeah. Some carriers require a fence and netting for a trampoline. Everybody requires a fence for a pool. Because if you have somebody that wanders on property and dives in the pool, I mean, that's a huge liability exposure for a carrier. So each carrier will have what they call, you'll see if you have a pool or trampoline, you'll see it on listed on your policy, you'll say pool or trampoline surcharge. And they'll just charge an extra fee for the extra liability that they're going to be exposed to. We have some carriers that will let us write a pool or trampoline, but they won't provide liability insurance at all for the home. So you have to buy a separate liability policy. Just gets messy. Just don't get a trampoline. Just make your life easier. Justin, get rid of yours.
Do you recommend trespassing signs? Do they make a difference in court?
It depends on your size. So it does, like me, I live on a quarter acre lot. It's really not that big, but if I owned acreage and I can't see all my acreage, then yes, put up those no trespassing signs, takes 2 seconds, and it relieves you of that duty of care you owe to that third party. Because, the likelihood that you have somebody's not great, but that little step will save you that. It'll give you that added protection, and it's just an added benefit to protect yourself.
I don't know if it would like really help people, but it was like,
Well, it can.
it's difficult to prove that they could have seen the sign.
If you get, so I used to litigate general liability claims a lot, and it's really big in those, especially for businesses. If they don't have no trespassing signs up or something like that, somebody comes on their business property, gets hurt. We used to litigate those all the time. And it really was a stickler in those. Or
For commercial.
yeah, for commercial, it's really a big stickler. For residential, it is. But a judge is not going to be as, strict on
It's not
it.
a get out of jail free.
Yeah, it's not a good, but it will give you that added layer. It's like, hey, I put up the signs. Like, it's on him. He didn't read it. So it gives you that added protection.
Yes.
All right. So the insured. So you, the person buying the house, you are also going to be run through this. It says credit score. What they do is they pull a soft pull. It's not like, the in-depth that they do. It's literally just it doesn't even pop up on your credit report. You don't see it. It's just like hey, what's a general idea of your financial strength? Sometimes you'll see it called insurance score, which just means your claims history combined with your financial strength. So they look at how often does this person make claims, how often, or what's this person's payment and financial history. All these things kind of factor in. Claims history. That was a huge one. If you're going out making claims all the time, your insurance policies are going to be very expensive. And One thing that not a lot of people think about, but 10-year extra pass carrier. So you guys all have cars, right? This is to help you for your auto side. Nice one. Do not shop your rates every year or every 6 months. It may be attractive to do that because you can save money in immediacy. But what's going to happen is an algorithm that runs in the background for every carrier. And if you change every year, this carrier is going to want to collect their money on the first year of your policy every time. So you're going to end up long-term paying more. So when you look at the long-term benefits, so the long-term premiums, you want to do every 2 to 3 years is your sweet spot to reshop your insurance, because that's long enough where you're tenured enough where they can spread the cost out. They can make a little bit of money each month as opposed to trying to do my cash grab each year. Yeah, I know, especially in this market, it's going to seem like I need to switch. My rates went up. I need to switch right now. But if you just switched last year, just try to give it a little more time, because long-term you're going to purchase. That's just a little helpful hint, I hope.
Can you throw out there the reverse side that you told me about, where I've been
Yes.
with the company for 20 years?
Yeah, so this is where it gets so tricky. So the longer you stay, the more you pay. It's also a slogan we have. Because your current carrier, your rates are going to continue to rise, right? They're just going to keep on trickling up. And because in their algorithm, they're going to say, oh, yeah, they're here 20 years. They're never leaving. Why would they go anywhere now? Well, that's the next carrier, the one you shop with. So it's like, I want to bring you on. The carrier's like, oh my God, they stay forever. Like, we don't have to collect all the money right away. So your rates, that is the biggest drop in the rates you'll see, is if you're 20, 30 years at a carrier and you switch to a new company, because this new company, they're like, all right, we can hold on. We don't have to collect everything right away. We can spread this out because they're going to be here forever. So that is also a benefit. But my recommendation is every 2 to 3 if you can, shop around, just see what's out there. You don't have to switch, but just see. And if it's enticing in 3 years, do it. If it's not, if it's close, you're going to get more benefit by staying with your current carrier. If it's a huge difference, make the change at 3 years.
So every 2 to 3 years, call it 4.
Yeah, 3 years call. And that's what we do for our client. If we have a client, I can't track every date of them, but I tell them when I hang up the phone on my initial call, it's like, hey, after we sign your policy, 2 or 3 years, call me back. I'll rerun your numbers and let's just see what's out there, because we have 53. We just added 2 more, so it's like 55 companies we work with. I'll shop the other 54, just see what's out there. There's no harm. It doesn't hurt you to do it. It only hurts you if you switch every year. All right. So then obviously the policy itself is going to be a driver on your premiums. So deductibles, I don't know if you guys are familiar with deductibles. It just means your risk in the game. So standard auto is like $500. That means if your car gets in an accident, you're going to pay the first $500. The insurance will pay everything on top. Same for the home. Standard deductible is about $1,000. Sometimes wind and hail, which we can get more into, is a percentage based, because we used to have a lot of storm chasers who'd come around. So a wind or hailstorm comes through, dings up all these roofs in a neighborhood or in a zip code. They pull them by zip code. Then a month later, you're going to get these people knocking at your door. So we just had a hailstorm come through. You better believe those storm chasers are on their way right now. And what they're going to do not ever use these folks. They're going to come to your house. They're going to knock on your door. Like, oh my God, I'm going to get you a brand new roof. You're going to pay nothing, or you're going to pay just your deductible. And you know what they're going to do? They're going to get you to sign a contract, and then they're going to leave to the next zip code. And then they're going to hire every Tom and Harry that they can find to build that roof for you, who are not licensed folks. And then if they may not even show up at all. So do not use the storm chasers. Let them just go to the next house, but it's going to seem super appealing. But what happened is that we also had an issue with fraud, where they would come up on roofs with hammers and would dig the roof up, and then they take pictures, and then they say, oh my God, did you know? And what happens is that led to a lot of fraud in insurance. That's why they switched from a typical 1,000 for a roof or wind and hail, which is typically roof and siding, to a percentage base, so it increases your risk, so it makes it less appealing to do those things. And especially when the market's bad and the economy's bad, fraud in insurance is like the easiest way to collect a quick buck. So fraud goes up, the economy goes down, fraud skyrockets, which means claims go up, which means your premiums are also going to go up with it. So coverage limits, we'll talk about those. We'll go through the coverage side. Liability limits, the liability, kind of like we were talking about, that's what protects you if someone comes on your property and gets hurt. But one little side note about liability that nobody really knows: homeowners liability insurance is written so broadly, it'll protect you anywhere in the world, not just your house. So let's say you're a Home Depot and you got a 2x4, you just bought your house, you're doing a project, and you turn, you clock somebody behind you in the store, and they're like, oh, I'm suing you, I got a concussion now, it's on you, pay me. What happens, your homeowner's insurance will jump in and protect you. They'll provide you a defense attorney, and then they will also pay for the claim itself if they feel you're liable. So that's a huge, huge benefit that nobody really knows about. So what I always tell my clients, if you ever get sued, just call me. We'll talk through and see if your insurance policy can help protect you, because it'll take the weight of a defense attorney, which is very expensive, off of your plate. This right here is the most important coverage you have in insurance. So I'll point this out right here. Water backup coverage. Water backup coverage is the most used coverage from any of my clients. Water backup coverage is a coverage that if water ever backflows from your plumbing into your home, this is what's going to protect you, because typical homeowners does not cover it. Or if you have a sump pump, say the basement, and a sump pump fails, and then your basement floods, this is the coverage that jumps in. It's the typical claim is about $9,000 to $10,000 for this alone. So, we usually bump ours to 25 or policy limits depending on the amount or the quality of the basement. If it's basement that's all finished, we usually bump it up big time.
What if I'm holding a 2x4 and I swing around and hit a pipe?
Still protected. Here we go. This replacement cost for ACV. ACV is actual cash value. Very important.
I ran into that with my house.
Did you?
It was built in 1922
Yeah.
with like big boards. And they said to build it today would actually cost twice as much.
Yeah. Oh, so what they probably did is something called functional replacement cost for your policy.
Yeah.
So functional replacement cost is a little more than weeds, but it's like an older home that's built differently. Honestly, built, teach me better. Yeah, a bit better. It's just sorry, it's just a more sound structure.
Yeah.
That was a big home. And what happens is, it's like you said, the materials today are a lot cheaper and a lot smaller. I mean, they are, so they don't. The functional replacement cost means that they're going to build it back to today's standards, but it'll be same kind and quality as their old home.
I would take it honestly. I get the new windows.
Yeah.
New electric.
Well, you get all new stuff, but some people, like when they buy a home, they love the old home.
Yeah.
Like they love the character of that house.
Right.
So if they lose that home, that's a big thing. So it's tough, but carriers are not going to sign up for the market. I'm going to build this old custom built, 1920s house that is going to take a bunch of specialty, and that's just not insurance. So one big thing about replacement cost is ACV. So let's just take this TV, for example, and I'm going to do the personal property side. This TV right here may be worth $1,000. I'm just using $1,000. That's the actual cash value of this TV. But you go to Best Buy down the street, it's $1,500. Okay. $1,500 is your replacement cost. You want to make sure you have that coverage. So that way, if you're in the worst day of your life and you just lost your home and everything inside, you don't want to then have to come out of pocket for the difference on your material, your items to buy your new stuff. So get this, we put this on every single policy for the home and for the personal property. So it's two different coverages. Because, like I said, I don't want you to stress about going out of pocket. That's not, you're already going through stuff. Just don't do ACV, actual cash value. It's going to suck. I'm just telling you. I did claims for a long time. It's going to suck. One little tip I give my clients too. When you buy a house, you move in. You're there 2-3 months. You've unpacked. You're done unpacking. Go through your house and take a picture of every room in your home from a different angles to capture all because what you're doing is documenting personal property. Create a folder on your phone, title it personal property, drop those pictures in there. And if you ever have to make a claim, you've already got the evidence of what you own. And it's easier to kind of make that list for the carrier because I got pictures. I already got the evidence. I assume it's done. You did it beforehand. You're not then just burnt your house down. And I was like, oh, I don't know what I had. I just lost my house. It's going to save you trouble.
I actually want to accentuate that point right there. My mom's house burnt down and we didn't have everything logged. I need to take my own advice and log everything in my home, but it was a huge pain in the ass. Like we had to, report all this stuff to the insurance company and try to remember what we had in our rooms and stuff like that to get it replaced. It was a pain.
You're going to lose a lot of coverage there because you're not going to remember everything you had. It's just not going to happen. You're not going to remember every desk and table and chair and everything because you're dealing with so many other stressors that's just not your priority in your brain. And you're going to lose the value of your policy that you pay for. So it's important to you that you get that value. So take those pictures, save them in a folder, forget about them until that day, then you'll have them ready. All right, we can move on to the next. We don't. All right, so now we're gonna talk about the coverages themselves. What do they need? Because this is the nut, meat and potatoes. So we'll start, this is just a typical homeowners HO3 policy, which just means your most robust homeowners policy. So homeowners policies, they're written on 1, 2, and 3, 3 being an open peril basis, meaning that unless it's specifically excluded in your policy, it's covered. So, and HO3 has typical exclusions. One of the big exclusions, I'll actually want to go through here because I'm gonna do a quick water talk because that water's tricky. So your deductibles, this one does a hurricane instead of wind and hail. They just title it hurricane. They let us do 1,000 for all of it. That's why you see all of the perils deductible applies. So like I said, deductible, that's your risk in the game. Dwelling, that's the reconstruction of your home. So what is the cost of materials and what's the cost of labor to rebuild your home and the cost of debris removal for your old home? Other structures coverage, anything that's attached to your land, but not attached to the home. Detached garages, sheds, fences, they abut to your house, but they don't attach to the house. But like a deck, that's part of your dwelling coverage because a deck is permanently affixed into the home. So that's where that delineation happens. And it's like personal property. The easiest way to think about it, rip the roof off your house, flip it upside down and shake everything that falls out. That's personal property. And personal property, it's like I said, do those tips, but it can get very convoluted when we make those claims. Just lean on your agent to help you with that. They're going to ask you for all this documentation, receipts, and things like that for replacement cost values. You don't do that on your own. Like lean on somebody to help you through that process because this is your first time doing it, whereas your agent's done this tons of times. And so applying to one delineation in personal property, let's say this TV is your personal property, even though it's mounted to the wall, but the mount itself is considered part of the home now. So that's where the delineation is so fine lined because the mount is permanently attached to the home. This is attached to the mount. So that's where the fine line is. Loss of use. You just lost your house. You got nowhere to live. It's uninhabitable due to a covered claim. You need somewhere to stay. That's what that goes to. It gives you 12 months of coverage that will help pay for Airbnbs, hotels, things like that. If you eat out more because you don't have a kitchen, like say you're in a hotel, I don't have a kitchen anymore, your cost of eating out, that difference that you pay each month is now factored in to that loss of use. It's essentially any extra expense you incur because you can't use your home. And that includes your commute to work. Like let's say you got to drive here, it's longer because you got to rent a house way out in nowhere. That difference in your commute would be covered by this policy. So it's little things like that that you need to maximize. Like I said, insurance companies are a racket. I mean, I sell insurance. I know it's a racket because they give you grief every time you file a claim. Well, when we file a claim, maximize your value. Like it's your turn to use that policy. Now, liability we already talked about. If you own a home, depending on the value of the home, no lower than 300,000, 500,000 is what I would recommend. We put 500,000 on pretty much every house. You're protecting you and your exposure to any outside folks from being able to take your assets. So if you own a $600,000 house, if you have $300,000 in liability coverage, the judge might say, hey, you underinsured. You're going to owe out of pocket or we're going to take your assets. 500,000, I've never seen a judge ever take those licenses. Now I haven't dealt with billionaires or millionaires, things like that, but I'm talking, folks, around here, this $500,000 would be more than enough to make sure you're protected. Now, another thing I would recommend is if you do have, car insurance at 250, 500 liability limits, with the 500, I would recommend getting an umbrella if you own a home or if you're thinking about buying a second home. It's a very cheap policy. That's maybe $300-400 a year, but it gives you an extra $1 million of liability coverage on top of that 500. So I have seen those be used and exposed. Would definitely recommend it, or at least talking about it. Medical payments coverage. And this coverage was created by insurance companies to help prevent small litigation. What it does. So let's say you have a body comes over, they stuff a toe or twist your ankle or something. No big deal, but then it's a day at work. Maybe they go to the doctor or something. So, nothing crazy. But what happens, they have out-of-pocket costs for that. They either got their deductibles, co-pays, whatever it is, and they miss a day of work, so they miss a day of pay. So they're a little bitter about that. And I've seen this happen time and time again. What happens is this medical payments coverage. Typically, it's about 5. You don't really need 5. Between 1 and 5 is fine. What it does is it pays that bill in wages for that person without admitting any liability. It's saying, hey, we understand you got hurt here. I'm not saying I did anything wrong, but here's a little bit of money to make, you whole, so you don't feel like you need to start dipping into that liability. Obviously, where they start filing lawsuits saying, oh no, I'm out of pocket, I'm coming after it all. So this, it may seem like it's not, this is a very important coverage to keep anybody from going up to that next level of liability. And we can skip all that stuff. I already talked about it all. That's it. You guys, I appreciate it. Thanks for listening about insurance.
That was awesome.
Appreciate it.
Good stuff. Do we have any questions out there in the audience for?
Why are they doing the 10-year roof thing? Is it just because so few new homes are on the market?
So what they call, this is what they term, they don't want to buy a claim, is what they say. So one of the reasons you can get such good value with your insurance, so like I could write the same home, and if it's 5 years old or brand new, like let's say Jeremiah just built it, a brand new home comes with warranty. So a lot of times insurance is like, all right, I'll give you $500 policy. I don't care because I'm not going to pay on pretty much anything for the first 2 years. They feel very comfortable. If you have a 5-year-old home, it's probably would double the price just because there's risk there now. With a roof age, as soon as you get to 10 to 15 years, let's say a hailstorm does come through, you're likely going to go to the full replacement model as opposed to a repair model. And that's a huge payment difference. So that's when they start to say, all right, well, if this storm does come through, the percentage you say the storm comes through 20% of the time, whatever the statistics are, then we're going to end up replacing the roof instead of just, fixing or patching. So that's why the roofs are a big issue.
It's because the market's going through replacement rather than repairs, and insurance companies are that we can't.
As soon as they hit that 10, 15-year mark, it's like the justification of just repairing as opposed to replacing is less and less, the older it gets.
Gotcha.
So they start to ramp up. But if you ever get a new roof, let's say you buy a house, put a new roof on, a year, 2 years down the road, call me because I can get your rates out. I can get your rate put back down if we put a new roof on.
So the new home buyers now, it's like they've got to basically include a new roof in the mortgage or they can't get homeowners.
No, I mean, I wouldn't say it depends. So I'm able to write up to 20, 25-year-old roofs with a lot of my carriers. It's okay, but it's just you're going to reflect it in your premium. It's just going to be more increased.
Gotcha. Okay.
Yeah. Then we can also get creative. I've done this with somebody actually right now who's redoing a manufactured home. The manufactured home needs a new roof and needs new siding. So what we did is we wrote that on an actual cash value for right now, just so that they could get the home closed. But then once they put the roof on, then we'll flip it to a replacement cost. So that way they do maximize that. But right now, the actual replacement cost and actual cash value, nobody's going to write a replacement cost because the roof is in such bad condition. Okay, so nobody's going to want to buy that new roof. So actually, yeah, that's it.
I got a random ask for the insurance guy.
Yeah.
I know you've been asked this a million times. It actually doesn't have to do with homes for a second, but
So yeah,
when you rent a car, do you
Yeah.
get the rental car insurance? I heard somebody ask you this.
you don't need it. Your insurance policy jumps right over top of it.
Yep.
So your coverages go right to it. You don't need it. I mean, you can get it if you want to pay a deductible. That's really all it is. It's a collision deductible waiver for your sign. You're just waiving the deductible. Done. You don't need it. Your insurance will jump right over to it.
And then I have a last random question. I don't remember this because I was younger. When my mom's house burnt down, her car burnt down in the garage.
Yeah.
What covers that? The homeowners or the car insurance?
So if I was you, I'd push for your auto to cover it because there's also no deductible with that. And that's just going to increase your claim on your home value. You could argue both ways. I could see you arguing both ways. But if I'm you, I'm pushing to have the auto side do it. Just because, like I said, there's absolutely no deductible with that car. With any fire claims, I had a guy who dropped a cigarette in his car, burnt up the interior a little bit, and it smelled. So smell is a claim you can make, just so you know. So if it smells bad enough, you can get that fixed. So that's what he did. He dropped a cigarette, burnt up. It didn't really cause much damage, but it started stinking. So the carrier totaled it. He had no deductible because it was a fire claim. But it would also, then you're also, let's say you do it all in your home, the home and auto together. What happens is you just added a $30,000 payout to your home claim too. So that is a little tougher to get through. It's just the more you pay out, the harder it's gonna be for next carrier to take you as a risk.
I'm speaking personally, I've had Allstate for years, but I'm gonna have Corbin look over my stuff because I like the fact of having somebody on my side in between me and the insurance carriers and not working directly.
And I take that very personally because I used to do claims, that's what I did for a long time. My wife still does claims right now. We are an insurance family. And we take it seriously. Like my business partner, Jeff, he ran Travelers claims in the Mid-Atlantic for a few years as their director. So we know where to push, how to push. So we know how to get things out of the adjuster's hands and up the chain to the people who get pissed off if it's in their hands. And that's when they pay. I mean, it's just not rocket science. It's just, I know what to say and how to say it. And if you ever get a water claim, I need to talk about water claim. Water is very good thing. If you ever have a water claim, don't ever use the word flood. Unless you have a flood policy. Don't ever say that word. It just doesn't exist in your vocabulary. Your house didn't flood. You had a water intrusion or something along those lines, or we'll present the claim for you.
It's just like the phones.
Yes, big time. But all right, water real quick. 4 ways you can damage your home. And it's very important that you know the differences. We talked about the water backup. That's one way. Typically, it's not covered. But with water backup coverage, you can buy that endorsement to make it covered. Second way is a flood. Flood is not covered by homeowners insurance. Okay, that's very important to know. But most of us here, except unless you're near the river, are in a floodplain X, which means the least likely to flood. I sell insurance. I do not have a flood policy. I'm not very transparent about it. I'm not going to sell you something unless I think you need it. I'm not going to try to sell it to you. So the way they define floods is, acre of land or more is inundated with water that is not typically inundated with water, or 2 adjoining lots are fully inundated with water that are not typically inundated with water. That's what triggers the flood term. Then pipe bursting, the third way, 100% covered by your policy, less your deductible. That your dwelling limits, 100% you get that. The last way is called water seepage. Water seepage is that slow trickle that over time causes damages. It could be a mold issue. It could be it wears away on the wall. It could all kinds of things. That is not covered by homeowners insurance unless you have a rare carrier that offers you endorsement. What I tell my clients, when you move to your new home, once a month, walk around to every piece of plumbing you have once a month and just do a quick check to see if I see any moisture I shouldn't see. If I see any water spots behind drywall I shouldn't see, check under any of the P-traps or anything you have, and just do a quick hand swipe to see, do I feel moisture that I shouldn't feel? Because if you do that once a month, you're going to get ahead of any of these issues before it becomes an issue. So that's why I always have that talk, because I don't want you to go out there and think, anything's covered. It's not. It's very important that you know the differences before you call me and then we talk here. That's it. Now I'm definitely done.
Wait, I got a question for you.
Yes.
Why isn't a pipe bursting under a driveway covered with home insurance?
So that would be a service line coverage. Because it's so.
It
yeah.
happened. I
Yeah.
was like, well.
So we put a lot of service line endorsements on our policies. It's not one of the most used, so I don't really bring it up on a lot. But service line coverage, what that does is that takes your plumbing, electric, and anything that runs from the house. So let's say the main junction box in your home or the main plumbing enters your house. From that point forward, the service line coverage jumps in. So anything that's from this point, here's your house, that runs out. Now that's the service line coverage. So service line coverage would cover those needs.
The last question, who's gonna pay for the Baltimore Bridge?
Who's gonna pay what? Oh, so I guarantee the government pays for it first.
Yeah.
And then they'll try to subrogate everybody. And because I used to do a lot of commercial litigation, and what's gonna happen is there's gonna be 1,000 people who pay a little bit. What was that?
Awesome. You guys have any questions for Jeremiah or Todd when it comes to, I will tell you, Todd helped me out big time with my last mortgage. I had a mortgage agent. In the middle of our buying cycle, he moved to a different company. There were some things a little jacked up. I didn't know Todd, but next door neighbor of my in-laws is a realtor, called Todd up. Todd got me across the finish line. Had never met him in person.
Yeah.
And then 2 months ago, we started this referral group and walk in and meet him. And I'm like, shit, you helped me. So Todd's awesome when it comes. I will tell you guys one thing learning in life. I'm gonna be 40 this year. It's very nice to have somebody you can call up on the phone. You're not dealing with the company, somebody local, somebody like that, because he's going to help you with your insurance claims. If you got an issue with your home or changes, you're gonna be able to call Jeremiah up. You can't call, no offense, James, I don't mean this the wrong way, but you can't call the owner of Brian Homes up and get him out there and get it fixed. You know, you have anything when it comes to money and stuff, you can call Todd up and he's gonna help you guys out. You guys are making the money and they want to treat their customers right and take care of you and stuff. So I highly recommend, if you guys want anything, hit these guys up. These are the guys. These guys can be a whole team. Lance unfortunately wasn't here today. His son had a double ear infection yesterday, so I assume that's why he wasn't here. But like, this is everybody you need when it comes to, this can be your team, and they're friends, you know, so they work together. So having all of them on your side, you're gonna have a leg up, you know. So I would highly recommend grabbing their cards, all that stuff, you know.
You guys get my cell, like all my clients get my cell, so that way you can text me too. Just say, hey.
All the time. It's all I have. Another thing, local with this stuff in the real estate market, you're using somebody out of let's say online or whatever. A lot of these agents won't take that offer letter from those companies because they won't know it'll close on time. We all have reputations and been around here doing business for a long time. So when you put an offer in, I'm going to call that listing agent and say, hey, I vetted this client. That's going to set you apart from the other 3 or 4 buyers that are going in on that property. I might know that listing agent, be like, hey, hook them up, things like that. So local will help you with that. With all of us, it's a big push. Yeah.
And a random question for you, Jeremiah. I know you guys do new builds and stuff, but like if let's say, you know, one of my crews are going to go and buy a home and they needed like some renovations done to it. Does CORELOT do things like that? Would you do things like that, like renovating the house?
We've been building the house, we'll finish the basement. We have some capabilities occasionally. Some other stuff.
So does FHA cover a new build?
Yeah.
It does?
Yeah, all those loans you can do new construction on. Yes. And Virginia Housing was another loan program that I wanted to get in with y'all. You can do 100% financing with those. They have grants for down payment assistance where it's matching funds. There's income limitations on some of that stuff. And sometimes we have other grants that come out through the year. It's already been used up this year, but it'll be back probably beginning of next year. So there's other ways to get in houses where you don't have to have a big down payment, and you can get creative. Yes.
Actually, I think one more big thing for you to tell us, the group, you said this in our 212 meeting a few weeks ago, but a lot of people are like waiting for, you know, rates to come down and stuff like that. Like, what are your thoughts on that?
I don't think rates are really going to come down this year, and at least not until after this election year. You know, I think they're going to kind of be like this, and they could probably trickle into next year, but the housing prices are continuing to rise because there's no inventory. That's the problem. People don't, you know, want to sell their houses unless they have a life event. So that's why building could be a better option. Set that plan up. You know, it's tough to say right now what's going to happen. A lot going on in the economy.
One thing you also, what you said when you talked about that a couple weeks ago is like, you know, like my interest rate's like 3.25 or something like it's low as crap. But you were like, people don't realize like this range of 6 to 8 is like where that's historical. That's normal. It's just the 3 and 4 was just super low.
The government pumped everything. The Fed kept those rates artificially low for way too long, in my opinion. And now we're paying for it. You know, I'm 2 1/4 on my house because I'm a VA, right? I'm never going to sell that house. Yeah. Like, even when I move, I'm going to keep it and use it as a rental property, right? I'm not doing that. So, but historically, if you go back over the charts of 60 years, 6% is a great rate. In the Carter administration in the 70s, rates were 17, 15%. You know, people say, oh, well, houses were lower cost, but so was your income.
Yeah.
So it's all relative. You know, you're going to build wealth if you buy real estate, 7 to 8% a year. You know, who knows with the crazy stock market and all these crazy meme stocks that people are talking about, you just don't know anymore.
Yeah.
So that's something hard, tangible you have. You know, 7% over a long haul is a good return in my opinion.
I know now like home equity lines of credit are pretty popular.
Yeah.
What are your takes on that?
Well, you know, if you need it, but the rates are going to be high on those. And a lot of those are going to be interest-only payments.
Mhm.
So you're just paying interest.
Yep.
You're not making that principal go down. So it's good to use if you don't want to go write a $30,000, $40,000 check on a rehab stuff on your house, you know, new kitchen or new dishwasher, or you're doing some repairs and things like that, and you have to do it. But you know, you got to look at your overall financial picture. You know, where's your money placed? Is it in the markets? Is it, you know, where can you leverage that market to work for you? You know, money to work for you per se. So it depends really on your situation, but that's evaluating, the rates are gonna be higher on those home ec lines now.
Gotcha. And they're adjustable too.
And they can float too, so they'll go up and down with the market. You gotta watch that as well. You know, it's
I'm
sometimes
open one right now.
Do you?
Yeah, so over the last 3 years, I think the payments doubled because it's a variable rate.
sometimes you borrow against your 401k or another asset, it might have better terms.
Yeah.
Yeah, so I can help you with all that. We spitball ideas all day long.
Okay.
You can't fit in one box.
Yeah.
In this, it's all customized for what you're looking to do.
Can you use an FHA loan on a multi-tenant new build?
Yes,
You can? Is that ever done?
yes.
Really?
Yeah, because it's 3.5% down.
Okay,
Yeah,
so they'll let you do whatever you want.
yeah, it just depends, like, it's 4 unit on 4 unit.
It's to be 4 units.
Up to, I think up to 4.
Yeah, 2, yeah.
That's something a bank would actually do.
Yeah, it's federal government backs that one, federal housing.
Okay.
Yeah,
So why doesn't everyone do that?
that's a good question. In Richmond, I'm down there a lot.
That's where he lives. He
Yeah.
drives up from Richmond.
So-
Yeah.
Churchill, all downtown, all those areas, everybody's buying up those multi units, living in one, renting the rest of them out.
But I could build a new 4-unit multi-unit on an FHA loan
You would
with
need to get it.
3.5% down.
Depends on how you build it. Do you need a construction loan? Because you might have interim financing in the meantime to build it. Or if the builder's gonna, float the construction cost on it, we can take it out as what we call secure that 30-year fixed with an FHA at the end.
Well, and Fannie and Freddie just came out with that product not long ago for that 5%.
Yeah, and I was gonna get into that.
Yeah,
Fannie
where
and
you
Freddie
go
go to
to
5 now. They used to not do that. So you can do that now. And a lot of younger folks are doing that. If they can find a property in Richmond or find a lot where they can throw something up like that, if they're doing it all the time now. Yeah. Yeah, get somebody else to pay your mortgage for you while you live there. Rent
3 other people.
Exactly. Yeah, cash flow
We'll
positive.
talk about putting up before.
Yeah.
Okay.
Keep rolling it, then you get into buy early. In 30 years, it's just gonna be an ATM for you. I mean, I kick myself for not buying some of these houses in downtown Fredericksburg for all the college students here. It'd be an ATM for me right now. Think about it as an investment.
Well, and the 5% one owner occupied, you gotta live there.
Yeah, you gotta live. Yeah, you
But
can't
the
just,
multi-tenant one, you just gotta live in one of the units for like
Yeah.
1 year or something.
that's exactly right. Occupy it within 60 days is what the doc says. Whatever you do after that, you got, that's up to you, but you gotta live in it. 60 days.
Okay.
Yep.
One last thing, hopefully last, because that pizza's calling
Yeah.
me. For Corbin. A friend of mine just got a trampoline. This is kind of an odd question. And the trampoline is not actually on the property. It's slightly off, like,
Is this yours?
it's all right, it's me.
Yeah. Okay.
But
And Corbin's your insurance.
Corbin's my guy, but what am I opening myself up to by having it off the property?
You're gonna, so if a claim happens, you're not gonna get paid. There's not gonna be no pay because the way the carrier's gonna see is you're actively attracting. It's like an active attractive nuisance. So it means you're trying to bring people on. Is it fenced? I'm assuming it's not fenced in because it's off the property.
It's netted, but I don't have a fence.
So there's gonna be no pay. If there's,
And we got neighbor kids coming over all the time, jumping on.
and that's.
When I was a kid, my friend had one. His parents actually made our parents sign permission slips if we wanted to go on it.
Oh, so you can sign liability waivers all day, but you can never sign liability waivers for no person's negligence. So like you see those truck signs on the back, like the signs on the back of a truck, dump truck that say, we're not responsible for any rocks that. Well, maybe not, unless they did something negligent to cause that rock to fly. So it's never just as black and white as I can't just write this form and then I can be as negligent as I want. That's not the law. It's just meaning you understand the risk, so you're assuming the risk. But if you did something negligent, let's say you took some springs broke or something you didn't tell them, or the netting had a hole and you didn't tell anybody, and they don't know it, and then they get hurt. Well, you can sign that liability waiver all day, but you're gonna be paying.
I think my takeaway is fuck tramp.
Yeah.
Everybody got their own session. I'm gonna shut it down. Thank you guys for attending.
They'll take trampolines, we just need to add it. But